dabbling with them, studying them, back testing, and looking for fair value gaps. And you have asked yourself the question all the time. I guarantee you have. How is he picking that fair value gap? Why is he getting in there? Why is my entries taking off as soon as I get into them? That's the repeating questions that come to me by my paid students. That's the same questions that come to me by way of the comment section that you don't see, that you can leave a comment. I can see it, but nobody else can see it because I don't want all that love fest. And yes, there's people out there saying, you're a fraud, you haven't done this, you haven't done that. I don't care about that. What I'm showing you is the stuff that works. I'm telling you, when I pick the fair value gaps that I trade on, I'm using predominantly this right here. Okay, there's other things that I do to further increase the likelihood of me being correct about the fair value gap. But this in itself is the easiest go-to strategy plan for you to be able to formulate an approach to saying, okay, I trust that the bias is bullish. I trust that the bias is bearish. Based on that logic, you're simply going to use this information as I showed here today. This is not a lecture where you're going to watch it one time and you're going to understand what I just said, because you're going to need to refer back to it a few times. You're going to go and look at old data and then refer back to what I said here, because I guarantee what I've said here, you're going to think that I've created an edited format because it went over your head the first time. Because you already have some idea in mind what you're reaching for a model. And you're trying to take every new little thing I talk about and press it into that to make it click for you so you can go out there and start making money. You have to try to defer that, push that aside. Because just because you're now learning more ideas about what makes a fair value gap valid or not, what happens when that shift in sentiment changes from you're not bullish for that morning session or that afternoon session anymore? What do you do then? Everything that you used here on the upside becomes what? Part of a market maker sell model. So everything over here that would be a bullish fair value gap would become an inversion fair value gap over here. Anything over here that would be an order block that would be bullish would be a inverted. Basically, it would reverse its role characteristic as a bearish order block. It would reverse its role. This is the lower quadrant on that SIBI right here. Now we have a range, like overnight range, and you define it like that. Other things you can do is you can do extensions off that and get an idea how far it can go for targeting, for partials, for potential reversal patterns. And what you would do is you simply take the range. The first one is you always want to reach for is the negative 0.5 level, and that one's here. And then negative 1 is one standard deviation, which is that. And we hit the lower quadrant on that SIBI on the daily chart. Let's go back out to the daily chart real quick. We can take these off for a moment. It's looking too many lines on the chart otherwise. This candlestick is the SIBI I keep referring to on the daily chart. See up here, daily. July 17, 2024. It's a Wednesday. That singular down close candle, that's the SIBI. This is the low of it. That candlestick's high. This is the high of it. This candlestick's low. Equilibrium. Lower quadrant is 20,489. The low of it is 410 even. 20,489. Go back into a 1 minute chart. 40 minutes, that level right there. See that? So excited because it's absolutely an endless supply of setups. Period. It will never be exhausted, okay? If we're bullish, if we're expecting higher prices, by knowing the highs in the last 5 days and at least the previous week's Friday, and then knowing the previous week's high and low, you will always know where order flow is going to come in, and all you have to do is wait for the displacement. What does that look like? Well, here we have the rally above, the high on October 10th. That's this level here, okay? If you put this on your own chart. That's why I'm leaving parts of this stuff out, so that way it causes you to have an interactive study where you have to go into your charts, highlight the actual high of October 10th, 2024's high. It's last Thursday, okay? But putting that putting that line on your chart and then watching how price gyrates above it and comes back down. It doesn't stop there and go higher. Even though it's bullish, it does not stop there and go higher. It does what? It digs back down into the range. That's exactly what you want to see. Because what that's doing is it's offering you the opportunity to study and measure its willingness to go deeper into that range. Does it want to do so? No. How do we know that? Because we leave that range and go back above the high of October 10th again here. And then what does it do? Do we buy it now because it does this and touches it? No. Give it an opportunity to run back down in. Does it want to take the relative equal lows here? No. It's left the bait here. Because you're being trained to look for relative equal lows to be traded to. But what happens if it doesn't do it? It's telling you what? It's not likely to go lower. And if it's not likely to go lower when you're already predisposed to expect higher prices, then you're what? You're in a buy program. Then expect protraction higher. You see that here. The market rallies back above October 10th. Now, are we looking for the market to come back down and touch that high like support resistance folks would assume? October 10th. Now, are we looking for the market to come back down and touch that high like support resistance folks would assume? No, absolutely not. What we're looking for is any inefficiency when we pass down, that will act as an inversion fair value gap. That's what this is right here. Now, as it's dropping down, I'm looking at that fair value gap, knowing that if it's really good, it won't even touch it because we spent some time in here and then left it. I'm going long right in here. I'll show you the executions in a moment. Okay, and then the market rallies up and it leaves these relative equal highs. And I'm noting in the video that you can watch on Twitter, I'm noting these volume imbalances. Volume imbalances are the most flexible, or it's the PD array of my repertoire that you as the analyst, you as the trader, you as the implementer behind pushing a button, if you ever decide to do that, you're going to see price go through these types of things, okay, because it's a measurement of willingness to see the price sustain and run higher or low. It can be used as an entry. It can be used as a partial. It can be used as managing your stop loss. But I like looking for these little tiny pockets in price action, and it's basically the absence, if you look real close. It's the absence between this candlestick's body or open and this candlestick's close. There's a wick touching, but there's no bodies there. That's what I'm highlighting in that video. It's got a little music track added to it on Twitter. Same thing here, small little separation between the candlestick's bodies. There's one in here, but I'm not worried about that one because I've framed one here and I've framed one here, and I'm watching how the price behaves. But then this fair value gap, which is what I was aiming as I entered the firm, it added multiple entries on it. Then when it dropped down into it, we closed that initially right to that low. I fired in there again, but I had already typed out that the launch time is now. I said at 8:30 the market's going to spool higher. Go watch that recording. You'll see every annotation just as I typed it then. Everything here is exactly how I left it when I recorded that live execution. But I timed it and told you very specifically the launch time is now. Why? How did I know that? How did I know that was going to happen? Because at 8:30, if I'm bullish, I want to see the price run down to a discount array. That's this fair value gap. It could have went down and touched this inversion fair value gap, and it would have been fine. It would not have changed anything. But because it didn't touch it here, and it created this fair value gap, and it already started to run up and left these relative equal highs, I know it's just coming back down in here to redeliver into here. That's why you'll see when I'm adding the executions on the chart, you'll see that that's where I fired in and added my last portion. And I already anticipated it by saying that the launch time is now. Hits it, stops the tick, and starts to rally up. And then I'm watching, do these volume imbalances support price? It trades up to it. Look at the bodies. You're respecting it. Then comes back down. Look at the bodies. See that? See the assholes and asshats. They're watching these wicks and they're looking at this. Look at this stuff. It doesn't have any rhyme or reason what's going on. You're a fucking clown. Look real close. You see the bodies? See what those bodies are telling you? And back into engine. You can see rather anemic opening range gap again. It just happens that the first fair value gap forms actually in that same area as well. So we have taken, we have the first presented fair value gap that never got traded to yet, despite being delivered to a downside and sell side. It did not get traded back into here after creating it. So this candle never made it up there, and no subsequent candle after that made its way up there. So the consolation prize was that we could see this fair value gap forming here, and the bodies were laid down and buried right at the consequent encroachment of that separation between this candlestick's low. And what we would want to see, what I would rather see, is Dow continue doing what it's doing, going higher, or consolidate, not drop. Let me go back into Dow. Dow either stays going higher or consolidates and allows ES to hold its ground, not break below this low. You don't want to see that. And notice this wick that I was drawing on. It's consequent encroachment. Stopped it here, traded back above it, and the bodies. Consequent encroachment of this wick, and then the low of that candlestick right there. You see that? And then this volume imbalance, we traded through it, and look what happened here. The body stopped on that high of that volume imbalance, and it stopped on the body right there at the open, and started rallying. And it went down into it, but didn't breach it. See that? It's interesting, isn't it? Back into this fair value gap, but the liquidity rests here. So it doesn't make any sense for it to come all the way up here just to get to that. It's already shown it's not wanting to go to its own sell side, which was down there. So far, even though it's decoupled, if you're going to want to listen to this again, even though it's not an exciting lecture, it's teaching you visibility through this chaotic decoupling between.